Welcome to the Explainer. Okay, as an investment analyst, I see a lot of companies trying to pivot, but today we're diving into a genuinely fascinating transformation from one of the most storied names in finance. We're talking about KKR. We are going to unpack their massive first quarter 2026 earnings report, analyze their rapidly shifting corporate identity, and figure out exactly how they're building a financial engine that is literally speeding toward the $1 trillion mark.
Now, when you hear the name KKR, I bet your mind goes straight to their famous corporate raider days in the 1980s, right? They practically invented the modern leveraged buyout. Their legacy was basically cemented with that epic $31 billion takeover of RJR Labisco. It was a deal so massive, so ruthless, it was famously immortalized as barbarians at the gate.
But listen, if that is still how you view this firm today, you really need to throw that old mental model out the window. Because as of their Q1 2026 earnings report, KKR commands a staggering $758 billion in total assets under management. They are playing a entirely different game now.
They aren't just a volatile private equity shop anymore. Back in the day, they were heavily reliant on unpredictable deal-making and chasing those big, splashy exits. But today, they've morphed into a highly diversified, multi-asset capital and insurance titan. They've actually become a central, stabilizing pillar in the democratization of alternative investments.
Obviously, a shift like that doesn't just happen overnight. The history here tells a really clear story. You have the wild founding days in '76, the crazy '80s buyouts, and then a major stabilizing moment when they listed on the New York Stock Exchange in 2010. But the real game changer, the ultimate pivot, was fully integrating Global Atlantic's insurance operations between 2021 and 2024. That move right there, that officially ended their pure-play private equity era.
So let's actually dig into these Q1 2026 numbers, because the momentum is honestly incredible. Beyond that massive top-line assets figure, they raised $28 billion in brand new capital in just 3 months. And they definitely aren't just sitting on their hands. They closed a $1.4 billion strategic acquisition of Arctos Partners, which plants a massive flag for them in the booming professional sports franchise space.
Now, as an analyst, I always tell people you can't just skim the surface. If you look at their GAAP net income of $364.8 million, you are missing the real story entirely. You've got to look at the adjusted, non-GAAP net income, which is sitting at a massive $1.25 billion. That adjusted number cuts through the accounting noise and gives us a much clearer, truer picture of their core cash flow generation. And the breakdown of their holdings perfectly illustrates that corporate metamorphosis we were just talking about. Traditional private equity, it's now just 41% of the pie. The rest is this beautifully diversified mix. They've built huge chunks of real estate at 16%, growth equity at 13%, alongside massive alternative credit and infrastructure plays. They are spread out everywhere.
So what is the secret sauce here? How do they weather market storms so effectively? It all comes down to fee-related earnings, or FRE. This is the holy grail in asset management. It's highly predictable recurring revenue generated simply by charging management fees on all those billions of dollars. They don't have to wait around for volatile, unpredictable deal exits to get paid anymore.
Just to put into perspective how powerful this specific engine has become, in the first quarter of 2026 alone, KKR generated over $1 billion, $1.02 billion to be exact, just in this stable, recurring fee income. It provides an unbelievable cushion during periods of low deal activity.
And it gets better, because this stability is supercharged by a concept called perpetual capital. Unlike traditional private equity, where a firm eventually has to return the money to investors, perpetual capital has an indefinite term. It secures long-duration fee streams because that money just stays in-house, compounding year after year.
Right now, KKR has a staggering $326 billion of their portfolio structured exactly this way. Think about that, $326 billion of perpetual capital, generating those sweet recurring fees essentially forever. It fundamentally changes the entire risk profile of the company.
All right, but let's take a step back and be objective here. No march to $1 trillion is a straight line. The market is incredibly complex right now. So to truly understand KKR's position, we need to honestly weigh their current headwinds against their tailwinds. On the risk side, they definitely face some real headwinds. Regulatory watchdogs are keeping a very close eye on the private equity-owned insurance model, which directly impacts their Global Atlantic business. On top of that, prolonged high interest rates are compressing valuations across the board.
and a sluggish M&A market, that means KKR actually has about $10.2 billion in gross unrealized performance income just tied up, waiting for a better exit environment to cash out.
But here is their ultimate trump card against all that market noise: dry powder. This is uncalled capital that investors have already committed. It's money KKR has sitting on the sidelines, completely ready to deploy into new investments the exact moment the timing is right.
And we are talking about an astonishing $118 billion of uncalled capital. While other competing firms might be struggling for liquidity in a tight market, KKR has an absolute war chest, locked and loaded.
This massive pile of liquidity translates into major tailwinds. It allows them to act aggressively as a provider of solutions, basically swooping in to buy up distressed assets during market dips. It also perfectly positions them to capitalize on the massive infrastructure supercycle we're seeing, pouring capital into the green energy transition and the absolutely booming demand for AI data centers.
You can actually see this specific infrastructure strategy playing out in real time. Recently, there was a June 2026 regulatory filing from the Louisiana Public Service Commission outlining KKR's corporate maneuvering involving a broadband provider called Vexus Fiber. It is a perfect, real-world example of how they are quietly, methodically building out digital infrastructure behind the scenes.
So, the crucial question for us is, how do we actually value all this complex machinery? It's a huge debate in the analyst community right now. The optimists out there look at those recurring fees and the smooth capital deployment, projecting strong margins that yield an upbeat fair value around $140 a share. Conversely, the bears are pointing to the risks in performance fees and intense fundraising competition, arguing the stock's fair value is closer to a much more cautious $98.
But you know who isn't debating? KKR's own management. They are signaling extreme confidence in their baseline narrative by aggressively returning capital to shareholders. By May, they had already spent $317 million repurchasing 3.5 million of their own shares at an average price of around $91. They even increased their share repurchase authorization by another $500 million and raised their quarterly dividend. They clearly believe their own stock is a massive buy.
As KKR continues its rapid, almost unbelievable evolution from an 80s buyout firm into a robust, multi-asset titan, I want to leave you with one final thought to ponder. They've nailed the shift to recurring fees, they're expanding aggressively into future-proof sectors like sports and digital infrastructure, and they are armed to the teeth with $118 billion in dry powder just waiting in the bank. What exactly will KKR buy next?